This next section on contributions deals with what's termed in specie contributions and its relation to in-house assets. We've already covered off previously contribution reserves and the tax deferral mechanism that taxpayers in the highest tax bracket can utilise through making contributions to super funds. This presentation, as I mentioned before, deals with in specie contributions. An in specie contribution is a contribution being made to super fund of an asset other than cash. And so sometimes members may decide to put an asset into a super fund that it no longer wants to hold separately or out in another organisation. And so depending upon what that asset is, the superannuation fund can receive it as a contribution, or in fact in some circumstances the superannuation fund can in fact purchase that asset from the member and exchange cash for asset. And I've covered a little bit of that in some of the other presentations about the rules pertaining to that. Or an asset can come in that can be treated as both, partly as a contribution and partly as a purchase. It's important to determine the nature of the asset appearing in the accounts of the fund, and also whether or not it is a contribution or whether it's been a purchase. From our end, where we see this for the first time, we go directly to the minutes, and as the auditor I go directly to the minutes as well, and also back to the bank account. So if I see an asset come in and I see no payment being made, then I know it is a contribution. Then all I need to determine is whether it's concessional or non-concessional. If I see some money going out to the members, then I know that there's a purchase involved, and so I then have to determine whether or not if it's a purchase of 100% of the asset or if it's a part purchase with part contributions. And once again, the minutes are most important in helping us to make a determination as to how this occurs. A contribution will count against the individual's concessional or non-concessional contributions cap for the assets that you put in, and of course the value of the assets will be added to the various other cash amounts for determining whether or not you've breached that cap. If the fund has purchased all or part of the asset, that is, it's not totally a contribution, a deduction cannot be claimed for the purchase component by the individual. In other words, as you know, from the individual's point of view or from an employer point of view, in making a contribution to a super fund there can be some tax deductions sought, but of course if the super fund is buying the asset from you, then there's no tax deduction. In fact, there could be some capital gains tax or some other tax issues, because in the transfer of the asset from an individual's name to the super fund is a sale. Even though no cash may have changed hands, it is still a sale, and it's classified, it is valued at the market value at that time. So care needs to be taken, as with other taxes like capital gains tax and stamp duties, when you do some of the transfers of assets across. So if you were to transfer land, for example, then of course there'd be a capital gains tax implication there and some stamp duty on that transfer, because the title deed will literally change over from your name as the vendor to the super fund as the purchaser. And of course timing can be especially important if tax deductions are being sought. So contracts and minutes and transfer forms are all evidence as to what date the transfer occurs, and of course the value attributed to that transfer. Where the fund acquires or accepts a contribution, the asset from the member, Section 66, which is the section of the Act dealing with this, lists the following as the only assets that can be acquired. The first is listed equities, units in managed funds, real business property, and then certain in-house assets. And so I'll cover each one of these off at the time. So these are instances where a contribution is being made or where the super fund is actually buying the asset. These are the four only areas that these can occur in. So listed equities, these are shares in listed stock exchanges, not only here but around the world. It can also be shares, options, currencies, contracts for difference, etc. Shares in privately listed companies, the Pty Ltd companies or unlisted fixed trusts, are not included in the definition of a listed asset. So if you want the superannuation fund to buy or you want to transfer shares in a private company or an unlisted trust, this cannot occur under the listed equities section in the Act. The second section, the second heading of assets you can transfer in are known as what's called units and managed funds. These are what's termed widely held trusts. These are trusts which have greater than 10,000 unit holders. They're usually publicly known. An example would be Macquarie Bank's trusts, Alpha Funds, BT, Perpetual Trustees, Vanguard, and there's another 10,000 listed around the world. Each of us would be exposed in some way over time to some of these managed funds. We should be fairly aware of that. The third deals with what's called business real property. This gets really tricky. Section 66 states that only business real property can be transferred across to a super fund as a contribution or buy it from the member as a purchase. Residential property cannot be acquired from a related party. So this gets very tricky. There is an actual ruling on this, and the ruling gives a lot of detail, a lot of examples, and I'll mention that ruling below. The Commissioner has states that the fund will obtain an equitable interest in the land once the contributor has done everything necessary to transfer legal title to the property across to the super fund. It's a nice way of saying you need to have a contract. And of course it's the dates on the contract which count, not settlement date, but the actual date of the contract. And secondly, if the value of the real business property breaches the contribution caps, then it can be transferred in percentages such as offered by tenants in common. Or of course, we may be able to use the contributions reserve mentioned in the other presentation. Tenants in common, might I add, are those instances where the percentage of each owner is listed. It's not 50-50. The percentages are listed on the deed. Of course, the percentages can change. What's business real property? Look at the ruling at 2009/1. It's an exhausting list, but what I suggest as a tip that before you start transferring in or having your super fund buy from your real business property, you need to have a chat to us about it. And remember also, other taxes will be implemented, such as capital gains tax may be triggered, stamp duty, and even land tax may come into bear. The last area that we're dealing with here is what's called certain in-house assets. Basically, a fund can receive as a contribution any other asset from a member, provided the acquiring of the asset does not cause the in-house assets being greater than 5% of the total fund's assets. The fund cannot even acquire the asset if it will breach the 5% rule. It will not work if you buy and sell the assets in the same year, so that at year's end you're less than 5%. It's illegal for you to even enter the arrangement if it's going to breach the 5%, so getting in and getting out before the 30th of June won't count. How is 5% of the market value calculated? Well, it's calculated at the time the asset is being considered. It's not the value at the last financial year or what the value is, at the next financial year. It's the actual value as at the date of that transaction. Let me give you a little bit of an example. Let's just say, for example, that you held some precious coins or stamps or valuable banknotes, and you wanted to get them personally from yourself into the fund. Then this is where this 5% business comes in, because it's not a listed asset, it's not managed fund, it's not business real property, so it comes under the other, and so it can't exceed the value of what you're trying to contribute, i.e. the stamp or the coin or the note can't exceed 5% of the market value of the assets. What about units and trusts that are not widely held or exempt trusts? Are these part of the 5% answer? Well, it can get a bit tricky here, and I'm not going to cover that in this format, but units in these trusts can be transferred or held, provided Section 71(1) Part A